BR Inc., ticker symbol BR Inc. on the New York Stock Exchange, completely crushed consensus expectations.
They really did.
We are looking at reported earnings per share of 8 cents, which just completely blew past Wall Street estimates.
Right, because analysts had actually braced for a 40-cent loss.
Exactly. And revenue came in at $78.82 million, beating the $77.5 million consensus. But, here's the headline anomaly. They beat that revenue estimate despite a massive 23.4% year-over-year drop in total sales.
Yeah, shrinking sales, but still beating the street. And looking ahead to the immediate future, management projected Q2 revenue between $83 million and $85 million.
With adjusted EBITDA landing between $1 million and $3 million, right?
Correct. And they actually reiterated their full-year guidance, too. So they're projecting $325 million to $340 million in revenue and $7 to $10 million in adjusted EBITDA for the year.
Which is wild. And, well, the market's reaction to this print was just aggressive. Shares rocketed up 22.8% the day following the report, closing the regular session at $11.25.
A massive rally.
So your mission as an investor tuning into this deep dive is to unpack this specific quarter and figure out exactly how a company that is shrinking its revenue by nearly a quarter managed to trigger a massive stock rally.
Right. You need to determine if this whole, shrink to grow strategy is actually a sustainable reality for a retail portfolio.
Or if it is just a temporary financial illusion. Okay, let's unpack this, because looking at this quarter is, it's a lot like cheering for a restaurant that served 30% fewer meals this month, but finally managed to make a profit on the soup.
That is a very apt comparison.
Since the top line dropped 23.4%, you really have to figure out where that revenue evaporated. And looking at the breakdown, the bleeding started directly in their core, direct-to-consumer or DTC subscription business.
Yeah, the contraction is heavily concentrated right there in that specific segment. When you dive into the financials, DTC revenue fell 25.2% down to $66.7 million.
Ouch.
And the volume drop is incredibly stark. Total orders dropped by 28% to just over 2 million for the quarter.
On the surface, losing more than a quarter of your order volume sounds catastrophic for a subscription-based e-commerce model. Usually that is the death knell for a direct-to-consumer brand.
It is. But what's fascinating here is the underlying architecture of that decline. When you look closely at the mechanics, management intentionally pulled back on highly dilutive marketing spend throughout fiscal 2026.
Wait, when you say dilutive marketing spend, you're talking about the aggressive acquisition tactics, right?
Exactly.
Like the Instagram ads offering a free Yeti dog bowl or a massive discount just to get someone to subscribe for 1 month.
That is the exact mechanism. In the direct-to-consumer space, there is this constant battle between customer acquisition cost and lifetime value. For years, companies subsidized growth by paying high acquisition costs to bring in low-value customers.
Basically bargain hunters.
Right, bargain hunters. And BRX stopped doing that. They stopped running the aggressive promos that juice the top-line subscriber count, but absolutely destroy the unit economics of the actual box being shipped.
So they consciously decided to weed out those churn-heavy cohorts.
They did. And because they instituted that financial discipline, the remaining base is structurally entirely different. Subscriber retention jumped over 170 basis points to 92.8%.
And for anyone tracking the margins at home, 170 basis points is 1.7 percentage points.
Right.
That might sound small, but in a subscription model where you are battling monthly churn, adding nearly 2 full percentage points to your retention rate is a massive shift in customer behavior.
It completely changes the compound growth of your recurring revenue. And while it doesn't stop at retention, average order value, or AOV, actually increased by 45 cents to $31.25.
Oh, wow.
And most importantly, subscriber lifetime value just hit a record high since BRX went public. The underlying story here is that they are monetizing their core loyal customers far more effectively than they did when the subscriber base was bloated with discount chasers.
I hear the logic on the cohort analysis, but, I have to push back here.
Sure.
As an investor, you have to ask yourself, is this actually deliberate financial discipline, or is this just market saturation disguised as a brilliant strategy?
It's a fair question.
It is incredibly easy for management to stand on an earnings call and say, well, we are focusing on quality over quantity, when they simply cannot find any new customers willing to buy a monthly box of dog toys. The pandemic pet boom is over.
It is.
If your target demographic is completely tapped out, the only ones left naturally are the loyalists. Are they just spinning an involuntary shrinking user base into a positive narrative?
That skepticism is entirely warranted, and honestly, it forms the core thesis of what short sellers have been arguing regarding BA Arc. However,
There's a counter-argument.
yeah, if this were purely market saturation and an involuntary collapse of the consumer base, the underlying metrics would behave differently. You would typically see average order value compress as the company desperately introduces new discounts to hold on to those remaining users.
Right, they'd be slashing prices to keep people around.
Exactly. You would also see retention slip across the board as macroeconomic pressures force consumers to cut discretionary spending. The fact that retention is expanding and AOV is rising organically suggests that this retained cohort is highly engaged.
They are actually buying more.
Right. They aren't just keeping their base subscription, they are successfully being cross-sold additional items. BR8 calls this their add-to-box revenue. The customers who stayed are actively choosing to add a $10 premium treat or a $15 extra toy to their monthly shipment. That points to strategic curation, not just a collapsing funnel.
Here's where it gets really interesting. Because while they are letting that core subscription box intentionally shrink to protect those unit economics, BRK is simultaneously leaning hard in some highly unconventional, diversified revenue streams.
Very unconventional.
The implication is that these new avenues will eventually pick up the slack from the shrinking DTC side.
Yeah.
And, well, we have to talk about the fact that they launched an airline for dogs.
We do.
Sounds like a complete gimmick, but BR actually brought in $3.2 million this quarter.
Yeah.
That is up 37% year over year, and management noted their Q2 flights are already 90% sold out. How does an investor value a pet company running $10,000 cross-country dog flights?
The BR Air revenue numbers are definitely surprising, but you really have to contextualize them within the broader corporate strategy. Management explicitly stated in this report that they are prioritizing unit economics over top-line expansion for the airline moving forward.
So they aren't trying to be Delta.
Exactly. They are not attempting to build out a massive logistics network or become the Delta Airlines of the pet world. The strategic goal is to ensure every flight is profitable, or at least breaks even, while serving as a massive, high-visibility marketing vehicle.
So it's basically a flying billboard that pays for itself.
Right. It creates a halo effect for the brand. But if you are a retail investor looking for actual structural growth, the real diversification play, the one that actually moves the needle on the income statement, is their commerce segment.
Right, the wholesale and retail marketplace side of the business, which, somewhat confusingly, actually saw revenue fall to $12.1 million in this quarter. That's an 11.4% decrease. If that is the growth engine, why is it shrinking alongside the subscriptions?
Well, if we connect this to the bigger picture of retail supply chains, you have to understand the lumpiness of wholesale commerce.
Lumpiness.
Yeah. Unlike a DTC subscription, which offers very smooth, predictable monthly revenue, wholesale ordering is dictated by massive inventory cycles. Retail buyers at places like Target or Chewy don't order a flat amount every month.
Right, they stock up all at once.
They issue massive purchase orders ahead of seasonal resets, like the fall and winter holidays, and then they don't order anything for months while they sell through that inventory.
Okay, that makes sense.
The first calendar quarter, which aligns with ARC's fiscal first quarter here, is historically the slowest period for retail replenishment because stores are coming off the post-holiday lull. What you have to evaluate instead is the future pipeline they are building.
And looking at the notes on that pipeline, it looks incredibly aggressive. They are targeting double-digit market share at Walmart, up from their current 3%.
Huge jump.
They are launching new product lines like the Licksters Enrichment Platform and their Bark in the Belly consumables on Amazon and Chewy. And then there's the rollout of these wild brand partnerships. They are putting out toys themed around Girl Scout cookies, Crocs, and Liquid Death Water.
Yeah, the Liquid Death one is crazy.
I have to ask, though, how much of this is real structural growth versus highly memeable marketing stunts? Like, a Liquid Death dog toy might go incredibly viral on social media, but does that actually build a durable consumer packaged goods business that justifies institutional investment?
That tension you just identified is the defining characteristic of BR's brand strategy right now.
Yeah.
Historically, they have always relied on cultural relevance and virality to lower their customer acquisition costs.
Because it's basically free advertising.
Right. A liquid death toy or a Crocs-shaped dog chew gets shared organically thousands of times on Instagram and TikTok, which is essentially free top-of-funnel advertising.
Mhm.
But to your point, virality alone doesn't sustain a publicly traded company.
No, it doesn't.
Management expects the commerce segment and BARC Air to collectively represent over $100 million in revenue this fiscal year. To actually hit that target, these products cannot just be funny on the internet. They have to perform on the physical shelf at Walmart and Target.
Which is a whole different ballgame.
It is. Moving from a 3% market share to a double-digit market share at the world's largest retailer requires flawless supply chain execution. It requires sustained sell-through velocity, managing stockouts, and proving to Walmart buyers that BARC deserves premium end cap real estate over legacy brands.
So what does this all mean? Because all of these viral toys, the sold-out dog flights, the battle for Walmart shelf space, absolutely none of it matters if it doesn't actually throw to the bottom line.
That's the truth.
And when you look closely at this quarter's shiny profitability headline, you realize it requires a serious flashing red asterisk. The headline margin looks incredible, but there's a major caveat hidden in the accounting.
It absolutely does, and this is where investors need to read the footnotes. The headline number that grabbed the market's attention and likely drove a lot of that 22% stock surge was a stellar reported gross margin of 72.7%.
Which is massive.
It is, and that high margin flowed down to drive a positive net income of $0.75 million. On the surface, transitioning from a heavy loss to positive net income looks like a massive fundamental turnaround for the business. But there's a very specific catch buried in that 72.7% figure.
A $7.4 million catch, to be exact.
Exactly.
The government essentially cut them a massive check, which completely skews the operational reality of the quarter, doesn't it?
It skews it significantly. The reported net income and that impressive gross margin include a non-recurring $7.4 million IEPA tariff refund. Right, it stands for the International Emergency Economic Powers Act. Without getting bogged down in international trade law, this essentially means the government refunded BRK for historical customs duties and tariffs they paid during past trade disputes, specifically allocable back to fiscal year 2026.
So it's a one-time windfall.
Yes. When you strip that $7.4 million out to find the normalized gross margin, which is the actual reflection of their day-to-day core business operations selling dog products, the margin was 63.4%.
Wow, okay.
And that normalized number is actually down 40 basis points year over year. So organically, their underlying product margins contracted slightly.
So wait, if we pull out the $7.4 million government check, they're technically still bleeding operationally. Their true operating profit without the refund was essentially flat, hovering at roughly $66,000, and their adjusted EBITDA was only $0.6 million.
That's correct.
So you have to wonder, is Wall Street just wearing rose-colored glasses, ignoring the tariff refund to bid the stock up 22%? Or does the fact that management reiterated a full-year adjusted EBITDA guidance of $7 million to $10 million prove that a massive back-half acceleration is legitimately coming? Because to hit that full-year number after this quarter, they need a serious ramp-up.
Well, the market reaction is less about rose-colored glasses regarding the tariff refund and more about institutional investors recognizing real structural operational discipline. While the gross margin was artificially propped up by that government check, you have to look further down the income statement.
At the expenses.
Right. The operating expenses tell a story of genuine, painful corporate cost-cutting. General and administrative expenses, or G&A, were slashed dramatically to $47.8 million, down from $57.3 million a year ago.
Cutting nearly $10 million in overhead in a single quarter is not just skipping the corporate retreat. That requires deep structural changes. How exactly are they pulling nearly $10 million out of their operating expenses without breaking the underlying business?
You don't achieve that level of savings without fundamentally re-architecting how the company operates. It involves reducing corporate headcount, consolidating fulfillment centers to lower lease obligations, renegotiating shipping contracts with carriers, and optimizing their cloud and vendor spend.
Okay, so a complete overhaul.
Yeah. And they also dropped their advertising and marketing spend to $9.5 million from $15.2 million. So even when you remove the tariff refund entirely, the company has vastly lowered its break-even point.
Nice.
The market is rewarding them because management proved they can drastically cut overhead, lean out the logistics, and still maintain a 92% retention rate. They didn't completely collapse the brand equity in the process.
And what about that guidance?
As for the 7 to 10 million full-year adjusted EBITDA guidance, you are right. It implies a significant acceleration. Adjusted EBITDA is a crucial metric here because it strips out non-cash expenses like stock-based compensation and depreciation, giving you a proxy for the actual cash flow the operations are generating.
So they're betting big on the back half of the year.
Management is heavily betting that the holiday season, combined with those new high-margin wholesale product launches like the Girl Scout cookie line, will drive massive volume over this newly lowered fixed cost base.
But, the income statement only tells half the financial story. While they are tightening their belts and showing signs of operational discipline on paper, checking the cash flow statement and the balance sheet reveals a very real ticking clock.
A very loud clock.
And it's a clock that the short sellers and bears are watching very, very closely. The liquidity situation is incredibly tight.
Liquidity is always the ultimate constraint for any consumer discretionary company undergoing a structural turnaround.
Yeah.
You can have the best margins in the world, but if you run out of cash, the game is over.
Exactly.
Looking at the balance sheet as of June 30th, cash and equivalents dropped sequentially to just $16.1 million, with an additional $6.1 million locked up in restricted cash. Operating cash flow for the quarter was negative $3.5 million, and free cash flow was negative $3.7 million.
They posted negative free cash flow, but they are simultaneously executing share repurchases in the open market. Executing buybacks while you are actively burning cash is an incredibly bold move when you only have $16 million in unrestricted cash sitting in the bank.
It is aggressive capital allocation, no doubt, but the cash burn itself is largely driven by seasonal working capital needs. To understand this, you have to look at the cash conversion cycle of retail.
Okay, lay it out for us.
BARK has to build up a massive inventory stockpile right now. They are currently sitting on $72.4 million in inventory. They have to pay the factories overseas today, put those products on cargo ships, and warehouse them just to fulfill the wholesale purchase orders for the massive fall and winter holiday rush.
Right, and they won't actually see the cash from those sales for months.
Exactly. But this massive working capital requirement raises an incredibly important question about their debt structure. BAK currently has 0 borrowings, meaning they are technically debt-free, which is excellent. However, to smooth out these seasonal inventory builds, they rely on a $35 million revolving credit facility. And that critical facility matures on August 29th, 2026.
That maturity date is literally weeks away from this earnings report. It's like running a marathon, hitting mile 18, and realizing you only have one energy gel left in your pocket.
It's a stressful position.
With just over $16 million in cash, inventory tying up their capital, and a vital credit facility expiring almost immediately, isn't this a massive flashing red flag for retail investors? If a bank looks at their shrinking top line and decides not to renew that facility, this liquidity squeeze becomes existential overnight.
It is the primary structural risk holding the stock back, and it is exactly why the institutional market is so deeply divided on BARK's future. You have massive hedge funds taking diametrically opposed bets.
Give us the breakdown.
Well, on the bullish side, you have institutions like Northern Trust and AQR Capital Management massively increasing their positions in Q1. AQR, for instance, added over 700,000 shares, an almost 14,000% increase to their portfolio holding of BRARK.
Wow.
Meanwhile, analysts at Jefferies recently raised their price target to $19, citing the aggressive commerce growth outlook and the lowered cost base. These bulls believe the operational turnaround is real, the unit economics are fixed, and that renewing a credit facility for a company with 0 current borrowings and improving EBITDA will be a standard, boring administrative procedure.
But then you have the bears, who are looking at the exact same numbers and coming to a completely different conclusion. Firms like Weiss Ratings maintained a firm sell on the stock. They're looking at the negative cash flow, the shrinking core subscriber base, and the broader macroeconomic pressures weighing down consumer discretionary spending.
Right.
They see a company walking a high wire without a financial safety net.
The bear case fundamentally argues that BARK is shrinking its way to a temporary profitability illusion. If consumer spending falters this upcoming holiday season, or if those liquid death toys don't sell through at Walmart, That $72 million in inventory suddenly transforms from an asset into a massive liability.
And if that happens,
If that happens, cash burn accelerates rapidly, and a smaller, albeit loyal, subscriber base simply won't generate enough cash to absorb the macroeconomic shock.
it really is a fascinating standoff between a highly disciplined, fundamental turnaround story and a very real structural liquidity risk. It forces you to decide which side of the balance sheet you trust more.
It really does. And, this raises an important question that extends far beyond just Barrick's earnings report.
Oh, really?
Yeah. If Barrick successfully manages this pivot, shrinking their traditional subscription box to protect margins while simultaneously leaning into wholesale partnerships and wild ventures like a dog airline, what does that mean for the broader direct-to-consumer industry?
That's a great point.
The era of cheap customer acquisition on social media is entirely dead. Are we about to see a massive wave of niche boxed subscription companies forced to morph into bizarre lifestyle conglomerates, media brands, and travel agencies just to survive? I mean, if selling the core product isn't enough to grow anymore, the entire BTC playbook is about to get very weird.
Be sure to follow the Deep Dive Show for your daily earnings coverage, keeping you informed on the numbers that move the markets.